Prabhat Awasthi joining us now right here in studio from Nomura, of course. Prabhat, good to have you with us on a day like today. Talk us through some of the reasoning here, because on one hand you have full-fledged fear of this pandemic. On the other hand, you do have market experts coming on saying, I would still buy, like going out there on a limb, sticking the neck out, saying I'd still buy at these levels. And do you think the market reaction is overextended? Do you feel it's still unknown, really, the kind of risk that could prevail here?
So I think what you said last, the unknown, right?
Yeah.
So the problem with this whole virus situation is that it is still a big unknown. And how do financial markets price it in? How do you price it in something? So the end game of obviously this is once this all blown over, what is the real economic impact, which you do not know now. So when you do not know that, what you do in markets is just jack up the risk premium of the markets. And when you sort of jack up risk premiums, then everything falls, so you're essentially pricing for risk which you don't know. Therefore, it's a widespread fall all across the globe. And which is why you're seeing riskier assets fall more. I mean, it's more the risky the stock because so higher beta is falling more, higher leverage is falling more, simply because there is no framework at this point in time in place which tells you how much economies will contract. It's all sort of moving, it's sort of a moving guess given how the virus is expanding. So I think we cannot for sure say, first of all, that we know exactly how this will pan out. Because if you go back 10 days, the response of people was different, or go 20 days, 30 days, when China numbers started coming down, people got very positive and markets rallied. And then it sort of came to Europe and then US and all of a sudden, and came home to hit us in India, and the whole perception changed. So we are still in that phase of forming perception and or sort of evolving sort of situation. And we'll really know what happens later. So at this point in time, this market is just pricing in a high degree of risk. And the reality, I think, will come to be known much later. So when people are saying that, well, you should buy, what they're essentially telling you is that, well, let's look at the multiple of this stock. It used to trade at, maybe 20 times, now it's trading at 12 times. If I take a 3-year view, well, it goes to 16 times also. And, build in whatever 1 year of wasted earnings, you still will be able to make some money. That's all they're telling you. Which might not be wrong. Might not be wrong.
Yeah.
But as I said, the point is that it's difficult to say how can it fall more. Of course, it can fall more. Simply because of the fact that the economic impact can still pan out to be much worse than.
And do you think that, everyone's been trying to say that given the records that we were trading at globally and even here, that initially when we started the fall, that it's okay in terms of valuations, in terms of, correcting to more appropriate levels. But now what do we think?
So two things, right? One, we were trading at records, well, not the whole market, but part of our market, right? US was obviously trading records. So the economic activity has been very strong. In India, despite slowdown, I guess we were trading at a level of market which you can call being elevated. But if you look at the broad market, it's not really doing all that much, because it was definitely, showing you an economic reality on a broad basis, which was much more somber than the headline index will have you believe. That's the first point. The second point, also remember, is that in the response to this virus, your risk-free rate has gone down to close to zero across the globe, except in India. But, you go back to, for example, the earlier crises, like in 2013, for example, when markets, because taper tantrum fell very sharply, our interest rates in India were 9%. And we're today sitting at 6%. Multiples are similar. So what essentially you're saying is that obviously things are much more grimmer today if we are trading at same multiples with 300 basis point cut in, risk-free rate. So I think obviously markets are pricing in the slowdown. They're pricing in an increased level of uncertainty. But I would still say that, the point simply is that if we don't know how bad it'll get, and it's really a bad virus, because we are not medical practitioners, and even medical practitioners have found it difficult to sort of put it in, there are different opinions out there. People are very bearish on this thing. People are saying, well, it'll sort of get contained. And if the other way around, then, things could be worse. But if I take a 3-year view and say, okay, fine, you'll have a 6 months, wasted 6 months, and eventually things will get controlled, then, bulls will be right, I guess. Because things will, eventually normalize.
Eventually.
And plus, there is a policy response. Interest rates, everything from India's perspective. We have never had 6% in last since 2008.
But then are you saying that some of those stocks, particularly in the broader markets, are looking attractive, or would you say stay away because you don't know the pace of the recovery?
So how do you judge attractive? Just by multiple, right? So multiple-wise, there everything is looking attractive. There's no doubt about that.
Yeah, it's a big sale if you were to just look at prices.
Absolutely.
But anyway, the point is that while yes, interest rates are going to fall more and more, this is also going to peg back. If you do think that this is going to have a lingering or systemic kind of effect, divestment, things like earnings recovery on a broad-based level.
Of course.
So that sort of pushes. I mean, while prices may do what they may be doing, but again, it's going to be a very hollow recovery.
So there are two ways, the way to sort of look at it, right? The point is that, again, you don't know. And what you're saying essentially could be very different from somebody else's perception of how things will
This
pan
is
out,
just
right?
probability A.
So therefore, exactly, right? So the point is, in the absence of not being able to know, how it will pan out. And then you go back to 2008 crisis and we can go back to 2001 crisis, but all crises are different. And this actually is first non-financial crisis, really speaking, which might turn out to be financial crisis.
Non-man-made.
Yeah, and it's the first of its kind, which is not an economic cycle, really speaking. It's a medical crisis turning into an economic crisis. We have no template for it, unfortunately. And therefore, we don't know whether this policy response is adequate or not, because your physical response to the virus is going to be what it's going to be. It's not going to be mitigated by the cut in interest rates, for example. People are not going to start traveling because you got cut interest rates. You can only mitigate some sort of, financial panic or liquidity panics in the market. Having said that, the fact is that, and I'm sort of, again, trying to act like a medical practitioner might not be right, but if you look at if you look at the east part of the economy, where China, Korea, etc., when they started really implementing quarantine, it actually worked quite well. Frankly, after 10-15 days, things started to normalize. Now, the question for us is therefore that if really quarantine sort of measures become very, very drastic, it will lead to a very short-term, very massive blip in economic activity. But will market react positively? And this is very short-term view if the numbers start to peak out. What happens in 1 month, they start to peak out because your interest rates are very low. So my point simply I'm trying to make is that you have to see things in balance. And on the balance, as an investor, you can take a 3-year view and say, such asset banking stock has always traded at like 20x and now it's trading at 12x. Let's say things go, and in all sort of economic scenarios, multiple collapse, they always bounce back to 20 because there's a particular ROE associated with the business, there's a particular way of doing business. Yeah. And therefore, will I be wrong in 3 years? Difficult to argue with that, unless the world goes to a level and this virus is so bad that things really go down the tube, which to me, given how it has people have been able to contain it in the China. Asian, not even China, I mean Korea, for example, Singapore, Hong Kong so close to China, even Japan is not getting any worse. They've contained it quite effectively. So if it is possible to contain it and eventually reduce the economic damage, then I think the market actually might bounce back in short order. And therefore, between the two, if the valuations become attractive, again and again, it's a guess, as I said, probably there's a case to sort of for long-term investors to dip in.
So if I'm slicing through your points on both sides, clearly you're saying take a 3-year view, and in that context, it may actually work.
You cannot take a 3-month view. No. Maybe you can take even a 1-year view, right? But 3-year view for sure, I think you'll make
So that definitely sounds like the voice of reason. Prabhat, thanks so much for joining us.
Thank you so much. Thanks
this morning.